as Finance Minister Nirmala Sitharaman underscores the critical role of capital expenditure, or Capex, in driving the nation's growth. Now, in fact, speaking at a recent event in New Delhi, Sitharaman emphasized that public capital expenditure remains a cornerstone of India's economic momentum, calling it a primary driver of sustained growth. In fact, she also addressed challenges, noting that while public capex continues to fuel progress, private sector investment has been slower to respond, with corporates holding onto large cash reserves. Now, she urged India Inc. to seize the moment and invest in capacity creation to complement the government's efforts. Now, as India navigates, remember, a complex global landscape, Finance Minister stressed the need for balanced growth, job creation and strategic trade policies to secure India's leadership on the global stage. So we put more light on the issue tonight with our guest, Madhavi Arora, lead economist, MK Global. Madhavi, thank you very much for taking the time out, joining us here on Business at 9 on ET Now. In fact, given what the Finance Minister has said, Madhavi, given the fact that how she's described the Indian economy as a picture of cautious optimism pointing to resilient fundamentals, but of course also flagging slow private capex, weaker credit growth and global slowdown as downside risk. So let's begin with the fact that how do you assess this balance of optimism and caution in the current macro environment? What do you make of that?
So actually, if you look at the India growth story the last 5 years or post-COVID rather, the first leg of big growth came from exports, which was again led by the fact that the global economy was rebounding and there was limited supply of goods, and whoever was able to supply was able to gain. India also did very well in the first leg. Then was investment, which was again led largely by public sector. Government did very well in terms of expanding its capex. Both center and state to some extent also participated, but it was a more center government-led capex, along with the fact that the real estate cycle also saw an onset. Both of them had ensured that investment did fairly okay, though it was still, going in patches. It wasn't a significant uptake as such per se, and there was a lot of inconsistency in growth because consumption was still again very patchy. And we did see some private capex come into fore, which was largely selective in nature. Some of it was compulsive capex and some of it was sectors like green energy, where we saw a lot of private sector interest. But largely, the private sector has been absent in this capex story, which played out until FY24. FY25 onward, actually, government also sort of tapered its capex. Both center and state capex had actually peaked at around 5.4% in FY24, and now it's somewhere hovering close to 5% in FY26. So obviously the government is a little uneasy that the private sector hasn't participated. But if you look at the large corporate balance sheets, they are obviously, as you mentioned, are the healthiest since 15-16 years. The utilization rates are also still in the mid-70s. So that doesn't really, incite them to expand their capacity further. At the same time, we are looking at a very uncertain global environment. At the same time, China's excess capacity is also a massive sore point in terms of expanding capacity for domestic players. But more importantly, I think they've been waiting for the the private consumption to actually pick up. They have been pretty endogenous to each other, both private investment, private consumption over the last 15 years or so. So I think, there's some bit of a missing cycle in terms of private sector actually waiting to private consumption to pick up. Otherwise, the incentive
True,
for
and
the
there is a missing loop. You're right, Madhavi. But taking a cue from all that you have put into perspective, sorry for interjecting you there. You made significant points as far as the uncertain global demand. You're also looking at the balance sheet, like you put into context. But this latest economic review also highlights doubts over private investment appetite, despite profitability and balance sheets, like you said. But from your perspective, what explains this hesitation? There's global demand risk, policy caution, or simply rather a preference for returning capital to shareholders rather than expanding capacity, which also you touched upon.
So I think it's a mix of all. As I said, it's, actually the constraint has moved more from supply from demand side. They have been waiting for the demand to actually pick up on the private consumption side, which has been sort of elusive, even though we saw some pickup in the rural economy the last 1 year or so. The urban economy is now starting to slow down. So there's not been a consistent increase in consumption to the extent that the private sector would have liked. And as I said, they are sitting with decent capacity utilization rates, just about in mid-70s. There also is a fear that there is ample China excess capacity in the world order if at all things don't go in the right order as far as trade dynamics is concerned. China could be still a big threat with regard to the supply that they have in hand. So I think it's both the demand and supply side of the story, which is giving less incentive to entrepreneurs to actually expand capacity, especially the large cap one, and they're sitting with cash in hand. Or India is also largely a shareholders economy. They would rather pay dividend than expand capacity at this point in time when there is limited demand in sight. I think that is the bigger problem at this point in time.
One of the words, of course, that you mentioned is the export and the numbers that you're putting in perspective in the past couple of years as well. With the global demand, we'll, of course, have to talk about the other significant aspect of the US tariff front. Everyone is, of course, awaiting what that's going to look like. But that continued uncertainty may also weigh on India's trade performance in the coming quarters. Do you look at it that way? And how much of a drag could this become on export momentum for financial year 26?
So we're looking at export growth, mercantile export growth to actually deaccelerate this year. We're looking at around -4% growth in FY26. I think the bigger risk is coming now from the services side of exports, wherein over the last 5 years we've seen extremely healthy performance, both from GCCs as well as even conventional IT companies, especially mid-cap IT companies. So I think that is also emerging as a big risk for overall exports, not just the goods, but the services side of it as well.
The other aspect that one would also want to touch upon, looking at how this is been in terms of the story as well for the past couple of years that we were looking at. Do you see specific sectors, renewable space, urban infrastructure, railway, highways, where private Capex could break through in the next couple of years? Or is that still a medium-term story that we're looking at?
I think it's going to be a medium-term story. See, the government also has reached its peak in terms of spending in these large sectors, right? So incrementally, public sector contribution may not be as much. You probably would see the public capex growing at around 7 to 8% on an annual basis, but as a percent of GDP, it's going to be stagnant, close to around 5%, both center and state combined. So I think that will become a big constraint, and thus it will be a more medium-term story. I think near-term, my sense is that a private investment would be more elusive than you would like it to be.
We'd also have to touch upon the fact that, Madhavi, there's a lot of talk about how AI has also entered the scene, AI job losses, stagnant wages, as well as global macroeconomics also playing a key. Has that contributed to low demand in your purview, or rather, what do you make of that particular situation? Because obviously it's the reality in today's times, and perhaps it could get worse. That, of course, times will be going to tell us.
Yeah. So if I look at India's consumption story as well, right, post 2022, there was a massive increase in IT and including BFSI as well, a massive increase in salaries of IT BFSI sector. And both these sectors are almost 60% of the listed space in terms of the wage bills. So the urban middle income economy actually enjoyed the uptick which was seen in IT BFSI as well as GCC industry. A lot of that has faded in the last 1 year. We are hearing a lot about urban middle income and urban higher, urban income sort of slowing, the consumption cycle there also looking to be a little more faded. All of that is actually coming from the fact that the income effect, which was going to the likes of IT and BFSI, is now fading. We do know that even GCCs are now starting to lay off, which wasn't the case earlier. While IT on an average has been still seeing net negative addition in jobs over the last 1 year or so. But definitely, I think we had underestimated the AI effect until recently. Things have obviously evolved much faster, and the adoption of AI has become much more cheaper than what it was a year ago. And that also is going to impact, domestic IT sector to a large extent. Just almost 40% of India's IT jobs are actually coding. So AI could just immediately disrupt that in an immediate run itself. So I think we are in for a difficult phase for IT industry. Plus, what we are seeing globally is also a slower growth cycle. US will not be growing at a 4 or 5% that we've been seeing post-COVID, but most likely a less than 1.5% growth that we may see in this year. That itself would impact IT companies in general. So I think the wage growth of the urban...
Right, and that is, of course, snowballing into the way that we're looking at. Madhavi, sorry for interjecting you again, but is the K-shaped recovery over now? in your purview?
Yeah, so our thesis has been that India's K-shape is no longer there. It's actually a broken thesis now. The most premium economy that that been enjoying the upper end of the K is now flattening. It's obviously not coming off, but incrementally it's actually flattening. The upper middle income is actually now joining the lower end of the K, while the rural economy, which has been absent for almost 7 years, even pre-COVID, has finally found its mojo and securely gone up the ladder without government's specific support per se, and there's been an improvement in labor dynamics. And the rural economy, which is the lower end of the K shape, has actually come up. So I think the K is largely broken at this point in time, and we're going to be seeing very interesting consumption dynamics as we go ahead. But overall, the consumption story and investment story in private sector is looking to be elusive as we get into this year.
All right. And while you point that out, of course, I'm going to come back to you to talk about the India Inc. story and like you put that into perspective as well. But before I do that, let's listen into the finance minister's reaction and then we'll continue this conversation, Madhavi.
Sure.
The numbers are there before you. Every year it's Prime Minister's clear instruction that you have to have the capital expenditure grow and grow significantly. And I confidently believe, based on the data before me, that that is one of the primary keys or one of the primary drivers of sustained economic growth. It can be higher, no doubt, but the level at which we've maintained is largely on the back of public capital expenditure and that which is growing every year.
All right, we heard what the finance minister had to say. But coming back to you, given what we were discussing about just a few minutes back, are there more dividends from the cash pile in the quarters ahead? Is that what we make of it?
Yeah, I believe so, because it's sitting on cash, and that's what I think has been disturbing the government a lot, because they've given a lot of sops to the large cap guys, right? Starting in 2019 when they reduced the corporate taxes, and have been essentially investing in big projects and large sectors, assuming that the large crop will also sort of join hands and there will be an inclusive Capex story in India, which really hasn't played out to the extent the government would have liked. As I said, there was indeed investment till FY24. Real estate cycle also played a very important part, by the way, in the pickup in the Capex story. But that seemed to have faded as well. Plus, as I said, there were compulsive investment that the government, the economy was seeing from the private sector, largely to sort of, reduce their dependence on the global dynamics, or largely in sectors like green sector where there was genuinely a lot of interest. But apart from that, there wasn't a broad-based pickup in capex, and there was, again, large cap guys have been absent and sitting with cash in hand, and with the lowest debt to GDP ratios that you've seen in the last 15, 16 years. So it's clearly a cause of concern, and it has to again be questioned whether, despite government push, would they be willing to actually expand capacity? As I said, I think the binding constraint has actually moved from supply to now demand. Unless there is a secular demand that they are seeing in the private consumption cycle, they are unlikely to really expand their capacity. Plus, there is so much happening in the global dynamics. Nobody would want to put a new capacity at a time when there's so much uncertainty around the world, and plus the world is aflush with excess capacity. I think a lot of factors are playing a part in them delaying, their investment decisions. So I think the policymakers would also probably move their focus away from the big guys to actually the mids and the smaller SMEs of the world, who actually can also contribute in a meaningful fashion to the India's capital expenditure cycle. I think that's where the focus of the policymaker incrementally is going to be. I think the large cap guys have sort of not been able to match the government expectation to a large extent in the last 5 years. And I think eventually they would have to move focus to the lower end of the manufacturing cycle, which is where probably a lot of capacity could also be generated.
Talking about that and how this could potentially go ahead, and with those numbers that we heard the finance minister also pointed, and essentially with public capex, Madhavi, at 11.21 lakh crore acting as the primary driver, how long can the growth story be sustained if the private sector remains on the sidelines? Because if you look at it, the government, of course, has extended significant policy support and, in a sense, hand-holding to the industry as well. But what more can be done to encourage the private sector to step up its role as a core driver of growth? Because essentially that's what you want the Indian story to tell.
Yeah, I mean, while you mentioned this number of 11 lakh crore, it's just the center. States last year actually was largely absent because on capital expenditure side, because they were moving more towards revenue expenditure owing to the election cycle. So last year was extremely bad from the policymakers and also as far as the public capex is concerned. As I said, center plus state was close to 5.4% of GDP in FY24. It was down to 4.8% in FY25. And FY26 also, we think it will be somewhere capping close to 4.9 to 5% of GDP. So I think that's a better way to look at the capex contribution of the policymakers than looking at the value per se. It used to grow at 20-30% at one point. Now I think the more medium-term growth of government capex would be somewhere close to sub 10% or lower on an average. So I think incrementally they would be playing a very important part. And mind that the government, despite giving incentives here and there, is still actually contracting its balance sheet as well, right? The fiscal deficit is coming down incrementally each year for the central government. So they, as a net contributor to growth, is actually not going to be as much, right? The fiscal impulse is actually negative on an incremental basis every year. So the focal point again becomes the private sector. And that's where, as I said, it's now becoming a chicken and egg problem. It's not that easy for policymakers to really prod companies to hire, right? And the private sector, you can only incentivize them to the extent. Beyond that is also the global cycle, which will play a very important part. Say like sectors like IT, for example,
which will continue to have that larger effect. You're absolutely right. But I have to interject you there because I'm afraid we're short of time. But having said that, Madhavi, thank you very much for taking the time out, joining us on the show, putting that into perspective for our viewers as well, and more importantly, how you're looking at this. But for now, we leave it at that because it's also time for a quick break here on Business at 9. Stay with us this Monday evening. We could be right back with lots more on the other side.